Morning, Bob.
Good morning, Bill.
This morning we're at the National Association of Real Estate Editors, and we're in Atlanta. It's an unusual time. Normally this is on Monday morning at 7:30 Central, 8:30 Eastern. Today we're in Atlanta and we're discussing mortgage automation. There may not be any need for mortgage automation given the plummet in mortgage applications.
Yeah, the refi's been dropping a bit with the interest rate going up. But you know, when we talk to our clients during the crash of the real estate market, they had to lay off a lot of people. And when they did this, they basically kept their most experienced people generally, and but that was a very small group of people because they didn't have any volume.
That's what they said anyway. They kept the most experienced people.
Right. And so as the market has started to come back up, and as they're anticipating market coming back up, they're talking to us a lot about, well, how much can you automate of this whole process?
Well, that whole discussion of automation has been a long-running topic, and it's, I mean, the whole premise was in the late 80s, early 90s, we were going to have the paperless mortgage.
Right. And
have you seen that?
I haven't seen that one yet.
I haven't either. Credit's highly automated.
Yeah, you know, it's interesting if you compare credit and the appraisal process, evaluation of the property. If you were to do the credit process the same way that you're doing the appraisal process, after you take the application, all the information from the borrower, you would then send out some sort of an investigator to validate all of that,
Just
right?
a picture and something to validate what was going on in terms of property.
A private investigator or something to make sure it's all correct.
We can't use something like Google or Bing Maps or some satellite photo?
For property, it's different. You know, for one reason, there is a lot of data available in the credit side. But they're just, the data, honestly, in the property side is terrible. And it has been improving recently, but it's dependent upon every county and the way that they collect data and the way that they publish data and what they choose to publish. And it's often terrible.
You know, speaking of automation, if we look at what has happened from a regulatory standpoint, we've moved away from automation. We had moved toward automation and valuation with the automated valuation models, but now with the 2010 appraisal and evaluation guidelines in regulated institutions, we've moved away from that. We've moved toward appraisals and away from automation.
Exactly, and what the lenders are struggling with is that implies that they're going to have to bring on a lot of additional staff. And even if they were to bring on that staff, the staff is not qualified to evaluate the appraisals. And so what
at least not under the regulatory guidelines.
Well, regulatory guidelines and the valuation issues both. And so what they've asked us to do is to try and automate a lot of that by two ways. One is to put in a lot of rules to check the appraisal and make sure the valuation is correct, the data is correct, all of that. But also they're asking us to provide guidance to the reviewers to tell them, okay, if this particular problem exists on the appraisal, what do you do about it? Because they don't know.
And so they want that automated.
Yeah, right.
Let's shift gears a little and let's talk about automation of underwriting. It appears as though that what we've had is if we go back and we talk personally here, we've had lenders that have been, at least correspondent lenders that have been, if you will, jilted. We had delegated underwriting and they were sold loans on a delegated basis. It appears as though that the underwriting was either non-existent or not up to par in terms of the flow they were sold. And so as a result, all of the correspondents are completely re-underwriting, which goes away from automation.
Exactly. And, you know, ultimately they're the ones that are responsible, are going to be held responsible. And they've seen the impact of accepting some of those loans underwritten by their correspondent banks, and they didn't like the results.
In most cases, we have a complete re-underwrite going on.
Right, and it's very expensive, it's time-consuming.
It holds up warehouse lines and everything else.
So how would you go about automating this whole process? That's the issue, and fundamentally it depends on two things. One, are you going to meet all the regulatory guidelines? And two, how comfortable are you taking a risk associated with that value?
Well, you know, there's an emerging thought, in fact, you've seen this in the popular press, that Americans are not willing to take risk anymore. Now let's talk about innovation, and we're going to talk about that. So really there are two kinds of innovation. The literature discusses two kinds of innovation: doing something new, which we can all relate to, and doing something you do today better or more efficiently. And so it appears as though that we're, at least from the emerging body of literature, that we're not willing to take the kinds of risks we've taken in the past. Why do you think that is?
Well, I don't actually agree with it.
Okay, well,
I mean, there was an article in the Wall Street Journal earlier this week or last week where they were talking about the fact that recently there have been fewer new entrepreneurial business coming forward. But what we also recognize is in the 2 prior years, there were record numbers of new businesses. And with the economy down, it's hard to, justify building a new building or a new business sometimes. But in terms of lending...
Well, that's new things, though, but making things better. Do what you do today,
right,
and doing it more efficiently or doing it in a better
well,
way.
Usually,
that's innovation.
That's absolutely right.
It's taking risk as well, but it's
yeah,
innovation.
And with mortgage lenders, the challenge that they have is how good does that value have to be in order to take that risk, right? Everybody would love to have a value that's absolutely perfect, so that they knew that exactly what the risk they were taking in terms of associating the loan size with the mortgage.
Well, the mortgage lenders we talk to, what they want to do is when they originate a loan and they sell that loan, they want that sale to continue as a sale and not as a comeback, a buyback.
Exactly, and one of the primary ways that those comebacks occur is that the secondary market then identifies a problem with the appraisal, or they felt that the valuation was bad, and then they put it back for that valuation issue. No one wants that. And so...
Because they can't price that. If they could price that risk,
it wouldn't
in fact,
matter,
that's
right.
the issue, really, is a pricing issue.
Exactly. And so one of the things that they're trying to struggle with and that impedes the process of the automation of the valuation is how accurate are those valuations? We have models out there that do valuations of the properties, but unfortunately they're not that accurate in many cases. And
there may not be sufficient data. Well, that's a big difference in the credit world versus the collateral world.
Exactly.
In the credit world, you've got a lot of historical data on which to make decisions. And you don't have that, at least you've not had that timely information. We've got public record information, but that tends to lag the market.
It lags the market, and fundamentally these are all models to begin with, and the accuracy of the model varies by the location of the country and the quality of the model being developed.
So how good do you need to be?
Well, that's the issue. If you have a 50% loan to value, you probably don't need to be that accurate.
But most lenders think you need to be good enough to make a sale a continued sale and not buyback.
Right, and so that means that you probably need to be generally within 10 to 15% of the value. And if you look at most models, they probably have about 60, 70% of the valuations that they do that are within that accuracy range. But the problem is the ones that are outside that. So and you don't know which those are.
So we have listeners that are in the origination space, the secondary market space, the capital market space. Let's talk about 3 ways to make the mortgage lending process better. So give us 3 ways. So look, there are storytellers and there are content people. You obviously have already figured out that I'm the storyteller and you're the content guy. So give us 3 ways to make the process innovative or more efficient.
Okay. Well, you've got to tell me which
well,
one.
You can choose either.
Well, I mean, fundamentally, if you're going to improve the valuation process, you've got to have better data. And you can't have every county doing data differently around the country. That's a problem. So if you were going to establish a way to improve the whole valuation process and speed up the mortgage process, it would be really outstanding if you could have some sort of a national standard for all data and the way that it was collected and presented for all of the public record data. Second thing that I would like to see is that one of the big problems in the mortgage industry right now is that they are automating and using computer programs and standardized ways of processing the mortgage, but at the time that the mortgage goes to the closing desk, all of that automation goes away. So you go to an attorney's office or you go to a closing company, and it all goes to paper and manually changing things at the last minute. So all of that automation that goes up to that point is lost because everything could be changed at the time of closing. So if we can...
And those are the official documents.
Those are the official documents, and so basically you've voided everything you've done so far. You've got to get that to be electronic. You've got to get it so it can be recorded in some way.
And one of the things we found is the data from the loan origination system and the data from the documents, the closed loan documents, which are the official documents, there's variation as much as 50% of the time.
Oh yeah, it's real high. And then the third thing that I would see that would really help right now is that the whole appraiser industry is in bad shape. Appraisers have been beat up over the last several years, often unjustified, but they've been beat up pretty bad, and the average age of appraisers now is something like 53, 54 years old. And
you're saying that's so?
Seems pretty young to me, but in any case, that's relative to other professions, that's kind of old.
Well, we talked about pictures. We talked about when we were sitting out in the audience and having breakfast, you and I discussed this concept of pictures. Underwriters tend to look at the pictures in the appraisal. And there's no real way to validate that the pictures are really the pictures of the subject or the comparables because there's no comparison. It would be very cool. You want to elaborate on that?
Well, I mean, it's a challenge because you get pictures from the MLS, you get pictures from the appraisals, but you really don't know that any of those pictures aren't just of the appraiser's neighbor's house or something like that. So one thing that would really be nice, or one way of changing the industry, would be if the lender actually gave a camera to the borrower and said, go take pictures of your house.
Or just had them take a picture with their iPhone or their cell phone.
It's going to be geocoded, it's going to be time stamped, you're going to know where that picture was taken, and you can match that to the property, and then you have a valid way of checking that. But those are all new innovations, and maybe that's for another time.
And the last thing that we have discussed is this concept of collaborative underwriting. So a correspondent seller and a correspondent buyer collaborate during the underwriting process. This is occurring some in jumbo loans where the correspondent seller needs a takeout on the back end, and so they're collaborating, especially in the appraisal process, because the correspondent buyer is a sole buyer. They can't sell it to the GSEs.
But that requires them to work typically in an electronic type of format.
Correct.
Because historically, the way the correspondents have delivered the documents to the lender have simply been either as a paper document, which is very common still, or as a PDF of just a bunch of images that they've scanned, which are dataless. And so they have to start everything from scratch. So.
Well, we're way over time. Dr. Dorsey, this is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey. Thank you all very much.
Thank you.